Welcome to the Real Estate Investment Club. My name is Daniel Homland. I'm the host of this club, along with a group that's in the leadership committee here. We aim to bring you interesting speakers on different topics in real estate every week. And this week we've got a fabulous guest. We have Amanda and Matt and I'll let them introduce themselves also, but they are both real estate CPAs and tax preparers. And so if you have tax questions about your particular real estate investment property or just questions in general, this is going to be a great session. So we're going to let Amanda and Matt speak for about 40 minutes, and then they're going to reserve around 20 minutes at the end for questions. And we'll wait just 2 or 3 more minutes to let more people come in before we get started. And so during this time, while we're getting started, I'll just say that coming up next week, we have another special treat. We're going to have Courtney Buck, who is a real estate investor who works for the Centers for Disease Control. And he's going to share with us his perspective on real estate investing in these uncertain times. So I'm looking forward to that. And then on Friday, the 29th, we have scheduled with us Whitney Sewell, who is the host of the Real Estate Syndication Show. And he hosts one of the more popular podcasts for real estate syndication that's being broadcasted out there today. And so that's going to be a special treat as well. All right, we're starting to get a fair number of people in here. So at this point, Amanda and Matt, I'd like to turn it over to you.
Sounds good.
All right, thank you so much for having us. We're so excited.
Daniel, you do want to start recording? You want to start recording?
The recording has been started. But if there are other people here that would also like to record it, I always like to get backups.
Oh, I think you have to share this one. I did do the primary. All right. So as we work out these technical difficulties, I'm going to share our screen. Hopefully you can see the PowerPoint. So my name's Amanda Hahn, and I'm here with Matt McFarland. And we're with Keystone CPA. Our firm specializes in tax saving strategies for real estate investors. So we're really excited to be here to talk to you about some new tax changes, as well as just general benefits with respect to investing. Daniel, can you see our screen on the agenda slide right now?
Yes, we can.
Okay. All right.
So yeah, thank you for having us. Appreciate it. And we're gonna, like Daniel said, we're gonna do our best. We'll leave some time at the end for some questions. Amanda and I are, just for you guys know, we're a husband and wife team, so we're not violating any work at home or social distancing rules or anything like that. So we both are real estate investors. We have a background dealing with real estate investors. I'd say probably 80 to 90% of our clients are real estate investors to some extent. So it's kind of what we like. It's what we understand. So we're excited to kind of share that information with you.
All right, so here's an agenda. As you can see, we have a pretty aggressive agenda to try to cover today. We'll try to finish the presentation part in about 40 minutes, and then the rest, hopefully have a lot of time for Q&A. To ensure that we have enough time to cover everything, we do ask if you can just jot down or type your questions in the chat, and we'll try to answer as many of them as possible after the presentation part. So real quick on the agenda, as you can see on our PowerPoint slide, we're going to go over some new tax deadlines from the CARES Act, changes for tax deductions on primary homes versus rental properties, ways to maximize tax deductions as a real estate investor. I think this is probably the one that most of you are interested in. What can we deduct? What are the best ways to track those? We'll also cover strategies to use retirement money for real estate, and then also touch on tax deferral opportunities with using the opportunity zone investments. And then lastly, we'll touch real quick just about the CARES Act and the various loans that might be available for real estate investors.
Okay, so a couple changes that came out recently. You may have seen this through the news, but excuse me. With the whole coronavirus epidemic, is that the tax return and payment deadlines have been moved back from April 15th to July 15th. And this really applies to kind of any deadline actually that was falling between April 1st and July 15th. So a couple things, if your taxes are going to be done soon and you're expecting a refund, you still want to consider getting them filed as soon as possible so you can get your money back, obviously. Or if you get your taxes done now and you end up owing money, you can file them now and still not have to pay the money until July 15th. So that's kind of a nice thing. And then if they don't get done by July 15th, you can still file an extension form just like before that will extend them, depending on the return. If it's an individual return, we'll extend you to October 15th. But the thing with the extension, keep in mind the payment is still due by July 15th. So even if you extend your return to October 15th, you still need to make your payment by July 15th. So that part of it hasn't changed.
All right, and additional extension, oops, sorry, I'm on the wrong slide. Additional extensions that are allowed for those of you making quarterly estimated tax payments, first and second quarter, that were due by April 15th and June 15th are also extended until July. So unless you have a instant desire to pay the IRS early, then, I recommend you wait until July to make those payments. Any of you owning California entities, such as LLCs or corporations, the $800 annual fee that's due to the state is also delayed until July 15th, so we have more time to make those contributions. Along those same lines, if any of you generally make IRA contributions or use a backdoor IRA, a backdoor Roth IRA strategy, or make contributions to health savings account, those generally are due by April 15th, but those are now extended until July 15th as well. Okay. Something that we didn't put on the slide I want to touch on real quick. I know a lot of our clients, we all know that there's a stimulus check coming, and for a lot of taxpayers that are of higher income, the question is, so what, right? I made a lot more money than I over the threshold, so it doesn't really apply to me. One thing to keep in mind, that is actually a tax credit on the 2020 tax return. Okay, so if you made too much money in 2018 and 2019, it just means that you won't get the checks right now. But if you can do some proactive planning to reduce your overall income for the 2020 year, you still could be eligible for that stimulus check. It just comes in the form of a refund when you file your 2020 tax return. So when we talk about tax strategies and deductions and savings, keep that in mind because we are talking about 2020 year. So any strategies that you use to reduce taxes this year potentially can result in reduced taxes and access to the stimulus check. Now, those of you who have maybe investment properties in other states, or maybe you have other income in other states, different states have their own deadlines. Now, the good news is the majority of them have adopted the federal deadline. So if you didn't file extensions by April 15th, odds are that's going to be okay for state purposes as well. But be sure to check that out with either the state that you're filing in or talk with your tax advisor about it. Okay. So, as you guys know, there's been tax changes. The most recent one came about under the CARES Act. The one before that was the Tax Cuts and Jobs Act of 2017 that came out in 2020. And there's so many changes in terms of rates and what you can deduct, but essentially at the end of all of it, the Tax Policy Center came out with this statement that says those with the same amount of income may pay very different total taxes.
So kind of, what does that mean? It was applicable before the Tax Cut and Jobs Act, but it really became prevalent and people I think are seeing it more often. But you think about your next door neighbor, you could both make, pick a number, $200,000, but maybe your next door neighbor has real estate, maybe your next door neighbor has kids, maybe, other things, different fact patterns. So even you're making the same amount of money, they may be paying a lot less in taxes or a different amount of taxes than you are. So just because people have the same amount of income doesn't necessarily mean they're going to pay the same amount of taxes. So just keep that in mind.
And an example we give all the time is, someone making $100,000 of W-2 income probably paying a lot more taxes than someone who's making $100,000 of rental income. And today we're going to go over examples of, why that is, why with rental income you pay a lot less in taxes. I think one of the most highly debated or discussed things about the last change in taxes was the new limitations on state income tax deductions, property taxes, and also changes to home interest. So let's talk about some of the primary home limitations that came out.
Yeah, so on the primary home side, mortgage interest limitations, the amount of interest you can deduct on your primary mortgage is limited to a loan balance of $750,000. Now, this only applies if you took out a new loan on the property or you, bought a new property after 2017, essentially. So if you had a loan in place before 2018, you get grandfathered in, so you can still have the $1 million old limit. But going forward, if you've bought a new property starting in 2018, then you are limited to deducting interest on the first 750. So what does that mean? If you have a loan in excess of 750, you just got to prorate your interest. So if your loan was $1 million, then you can deduct 3/4 of the interest on your loan in that example. Home equity line of credits, you used to be able to take a deduction on interest up to a loan balance of $100,000, no matter what you use the money for. So you could have gone on vacation for a year and the interest would have been deductible. But starting with the Tax Cut and Jobs Act, that's no longer the case. Now, the workaround there is for the real estate investors, if you happen to be borrowing from your primary residence HELOC and you use that money to invest in a rental property, you can still deduct the interest from the HELOC against the rental property under the general interest tracing rules. So there's ways to use the HELOC to your advantage. It's just if those situations where you're just kind of borrowing the money, sitting on it, or using it for vacation, or just pay for living expenses, that's not going to be deductible most likely.
Yeah, and then the other one that came about that, probably a lot of you have been negatively impacted is that the primary home property tax as well as the state income tax has been limited now to a max of $10,000. So, I think for most individuals, probably your state income tax alone was higher than $10,000, in which case that just meant your primary home property taxes became non-deductible or didn't get you an actual benefit. Now let's turn over to the rental property side. Okay, it's really important to make a clear distinction because on the previous slide, everything we were talking about related to primary homes only. None of those limitations and restrictions apply to rental real estate. What does that mean? Well, earlier Matt talked about that $750,000 was the maximum loan amount on new home acquisitions. That does not apply to rental real estate. So mortgage interest on rental properties can still be fully deductible regardless of the loan amount. So you can have $1 million, $2 million, $5 million in total loan interest or debt on interest, and those could still be fully tax deductible to offset rental income. Same thing with respect to home equity line of credit. So HELOCs on rental properties, the interest on those are still fully deductible, provided that you use the money for additional investment properties. And just to go back real quick, what Matt talked about earlier was on a primary home, even though generally you can't deduct the interest, if you use the loan proceeds for rental real estate, you can then turn that non-deductible interest into a tax deduction. Okay, so very important. We've seen a lot of clients over the last year or two with real estate values being high to refinance on their home to buy rentals or to refinance on a rental property to buy more rental properties. Make sure you let your tax advisor know about that because that means a lot of that interest can be tax deductible and do not have to go under those new limitations. Okay.
Now, a little caveat there, throw a twist into the fact situation. If you take a HELOC out on a rental property and use that to make improvements on your primary residence or pay down your primary residence mortgage, the interest on that HELOC is actually not going to be deductible against your rental property. One, because it wasn't used against the rental property. And two, it unfortunately can't be deducted as primary residence home mortgage interest either because of a quirky thing in the tax law because that HELOC is not secured by the primary residence. So that's a very specific fact situation, but I mention it because it comes up a lot. So if you borrowing on your rental and using it for your primary, you really should talk to your tax advisor and see if there's a different way to structure that before pulling the trigger on that.
Yeah, I think at the end of the day, the IRS is trying to give you tax incentives for using money for investment property rather than the reverse, right? Tapping into investment to benefit your own primary home. The last piece is that we talked about, there was a limitation on primary home property taxes. Again, that does not apply to rental real estate. So it means that property taxes on all the rental units you have or will be investing in, those are still fully tax deductible with no limitations. Okay. Now, so these are just some of the kind of more recent changes and a lot of confusion regarding, are the benefits of real estate taken away? As you guys know, the current administration is, pro-investing. Real estate investment has always been a tax shelter for higher income individuals, and none of that has changed. If anything, the tax rules and benefits for real estate investors has only gotten better over the last couple of years. So we'll talk about some of those deductions right now. I think most investors are pretty good at, tracking what we consider property-specific expenses, right? Like mortgage interest, property taxes, right, management fees. But I think one of the most common mistakes we see is investors not tracking what we consider to be mixed use benefits. So things that you're spending money on already personally, but could be legitimate tax deductions. And I think one of the most common examples is the home office deduction.
Yeah, so for those of you not aware, home office deduction's been around for probably 20 years. It used to be a big red flag item, but not anymore, just with the number of Americans, even before the coronavirus, the number of Americans working from home.
We're now clearly all working from home. But
right. Everyone's got a home office now, right? But the home office deduction, the benefit of it is that, with your primary residence, we can deduct interest and property taxes. But there's a lot of those other things like insurance, utilities, repairs,
cleaning fees,
monthly security alarm, any kind of expenses like that we're paying that generally not deductible because those are considered personal items, right, or personal expenses. The benefit of home offices is if you have a qualified office at home, you can convert a percentage of or a portion of those non-deductible personal expenses and now turn them into tax deductions against your rental property or your real estate business. So that it's overlooked a lot because people just don't, maybe, I don't know, they don't think they can qualify. They think it's a red flag for an audit or whatever the case may be. But it's one of those things where if you do have a home office that you're working from and it's a dedicated space that you're using for business reasons, don't be afraid to claim the home office deduction.
Yeah, and I think there's a lot of confusion. So, common misconceptions is that if you, work at an office, let's say, for example, you have an office at Intel, that you can't have a home office. And that's not correct at all, right? At Intel, that's your job. But where do you manage your real estate? Where do you look for deals? Where do you look at your finances and do your accounting for real estate? If that's at your home office, then you very well could be able to claim a home office deduction. The other part of that concept is the home office does not necessarily have to be an enclosed room separately. It just has to be an area in your house that is used exclusively for business purposes. So you can see on our slide, we have an example of this is like the end of a hallway, maybe in an apartment in New York. So it doesn't have to be fully enclosed. The area just needs to be used exclusively for real estate purposes. And that area should be eligible for the home office deduction. And, I think, like Matt mentioned, a lot of people have, been told or read that home office deduction is a big red flag. And that's actually something that was true maybe 2-3 decades ago when it wasn't really prevalent for people to be working from home. But, as you guys all know, many people are working remotely now, especially with respect to real estate. And I would have to say, I don't really have many, if any, landlords who own rental real estate that go out and rent an office space just to manage their properties. Okay, so this whole concept of big audit risk is something that's extremely outdated. Definitely something to consider taking a deduction for if you have a qualified office.
Yeah, so our next strategy that we talk to clients about a lot is what we call income shifting. And this is just a fancy way of saying, is there a way to incorporate paying family members to help you in your business and take a tax deduction for it? So obviously the picture on the screen shows a father and a son. We may think of the father showing the kid how to do something, but it's probably really the other way around, right? He's showing his dad how to use Excel or Zoom or something like that, right? So, but we all know that for those of you who have kids, obviously kids are very expensive. There's a lot of money you're spending on kids. So the idea behind this is that you're already spending money on the kids, right? So how can we take a tax deduction for the money that you are spending? So the way you do that is you get them to help you in your business and you pay them for the work they're doing. Now, obviously, the work that they're doing needs to be reasonable for their age and what they are, would be expected to be able to do. So obviously, a 3-year-old shouldn't be your IT consultant, but I don't know, maybe some of you at Intel, your 5-year-olds are pretty smart for all I know. But and the amount of money you're paying them has got to be reasonable for the work they're doing. So you're not paying them $50,000 a year to an 8-year-old, obviously. So, but the idea is that if you are in a high tax bracket, say you're in one of the higher rates, federal and state, you're paying 40%, and if you pay your child $6,000, they may be paying zero income taxes on that, but you're saving 40% on that money. So as a family, you're saving, 40% of that $6,000. And it's $6,000 you're already spending on your kids anyway, right? So we're trying to incorporate it into your business and take a tax deduction for it.
Yeah, and the older the kids are, the better the strategy could be implemented for a couple of reasons. One, when they're older, they can do more things, right? They're more able to earn higher income based on age and ability. And the other part of it is when they're older, they require more money. So instead of saying you're paying for their car, then maybe they work for you, you pay them money, they use that money to then pay for their own car. Commonly people say, well, my kids are so expensive, how can I take a deduction for it? Well, you can't really just deduct your kids, but there are other ways that you can incorporate them into your business and be able to take a tax deduction. Okay.
And this can work well too. We're talking about kids, but this can work well if anybody has parents living at home that are in a lower tax bracket than you are, and if you can get them to help you in your real estate business, this can work by paying them as well. So it definitely applies to that situation.
Yeah. On the next slide, we just want to share, this is something funny. This is a slide we call You Can Deduct What? These are all tax deductible items that has been decided upon by a tax court to be legitimate tax deduction. So you can see pet food, wigs, private planes, babysitting fees, breast augmentation, landscaping, swimming pool, and even a girlfriend. All of these cases, though, have a unique story and background to them. And believe it or not, several of these court cases were the results of creative real estate investors. So I think the private plane was one of them. The girlfriend was one of them, is where a guy was giving money to his girlfriend to help out in his property management business. IRS said, no, you don't get money for, you don't get a deduction for giving money to your girlfriend. The IRS actually lost that in a court case because they were able to prove that the money given to the girlfriend was for her to help out in his real estate business. So we just share this slide with you guys so you have an idea that anything could be potentially tax deductible. It just has to fit the facts and circumstances. Okay, we're not saying that if you went out and got breast augmentation, it is tax deductible. The question though is, how does that relate to your real estate business? How is that necessary and ordinary for your real estate business? If the answer is yes, then it's possible that it could be a tax deduction. And so make sure you have that conversation with your tax advisor before you spend money on something that you're unsure whether it could be tax deductible. That's when you talk to them. Maybe you're flying out to Florida to look at real estate. Maybe also take the kids to Disney World, right? What part of that could be deductible? Any of it? All of it? That's where the planning comes in.
So the takeaway here is, if you're going to get breast augmentation, talk to your tax advisor before you do that. Is that
exactly?
Okay.
Yeah, before you spend
that's
a large amount of
hearing,
money on
so
everything.
I just want to make sure.
And again, the higher the tax bracket you are in, the more important it is, right? Because if you're in the 50% bracket, having a write-off saves you 50 cents on the dollar. Okay. Now, these are all the general deductions that you can get as a real estate investor. One important thing to keep in mind is you do not have to have a legal entity to take advantage of those. They work with or without a legal entity. But we want to talk about a deduction that is specific to real estate investing, and that is depreciation and cost segregation.
So, for those of you who invest, kind of a comparison, those of you who buy stocks, you kind of all probably realize that when you buy the stock, you're not taking a tax deduction at the time when you buy the stock, right? You don't get to write off the stock until you actually sell it down the road, and you offset your sales prices price to get a gain or loss. The benefit of investing in rental real estate is different because when you buy rental real estate, the IRS allows you to take a tax deduction for a portion of the purchase price every year as if the property is quote unquote deteriorating in value. Now, obviously, the goal when buying real estate is to get cash flow positive and also that it's going to appreciate in value. But the IRS is going to give you a tax deduction on paper as if it's going down in value. And that's what they call depreciation expense. So very simple examples, you buy a property for $100,000, you have to look at, well, what's the building portion, what's the land? The land portion you can't take a depreciation deduction for. For the building you can, and with residential real estate, you write that off over 27 and a half years. So that might be a couple $1,000s of depreciation every year. And depending on the number of properties, that can add up, because that's going to offset if you've got positive cash flow. That's going to help bring your positive cash flow closer down to zero, so that you got tax-free income in your pocket that you're not paying taxes on right now, which is the goal of doing the tax planning with rental real estate. So that's that's the basic way of doing depreciation. But one of the better ways to do it is through cost segregation. Is how can we take more depreciation sooner? Because obviously, if we can take a lot more of that depreciation deduction up front, we can take bigger deductions, saving more money now, and then you can reinvest that money into future real estate.
Yeah, and here we just go over kind of a really high-level example. Let's say you bought one rental property and you put $60,000 down, right? And we'll assume that the building value of this property is $250,000. If you were to do a cost segregation to accelerate the depreciation, the first-year write-off could be up to $75,000. Okay, so think about that. You make a $60,000 down payment, but your write-off could be $75,000, right? So you can write off more than the cash out of your pocket. Certainly can't do that kind of tax write-off in the stock market. So this is one of the things that's very unique to real estate investments. And if we assume you're in the 37% tax bracket, the first year tax savings could be about $28,000 worth of cash, right? And so you can see how, the more real estate you own, these various strategies can really start to reduce total taxable income from a real estate perspective. Another thing I want to talk about real quick, currently in 2020, we have a bonus depreciation eligibility, and that is for real estate investors as well. So that means if you, for your real estate, if you're putting in assets like washer and dryer, microwave, furniture, refrigerator, a lot of those types of things, you can take a bonus depreciation where you write off 100% of the purchase price of those immediately in the first year. Okay, so something definitely to consider. Now we'll talk about real estate professional status. So this is important because all the deductions that we've talked about so far, okay, they are available regardless of whether you are a real estate professional or not. So even if you work full-time or both spouses work full-time, you could still take all the deductions that we talked about previously. Now the question becomes, if we did a really great job and we've wiped out all of our rental income so that we don't pay any taxes on any of the cash flow that we're getting, right? That's really great. But what if we still have expenses beyond that where we created a loss? The question then becomes, can we use that loss to offset taxes from our W-2 income? And the answer will depend on what your total income is. But at a high level, if your total income is above $150,000, that means those additional rental losses cannot offset W-2 income. You can, however, carry them forward to offset taxes from future rental income. So that's kind of a little limitation there for people who are trying to use real estate losses to reduce taxes from W-2. Okay, if your income is under 100,000 or under 150, you could still use some rental losses to offset W-2. But if you're over the threshold, generally you cannot do that unless if you or your spouse qualify as a real estate professional. So if you or your spouse qualify as real estate professional, you then can use rental losses to offset W-2 and all other income without any limitations. So let's talk about what is the definition of real estate professional and how do we meet that definition?
Yeah, and this is just in the tax world, so you're not going to hear this term anywhere else. I mean, it doesn't apply to anything else. We're talking about, can you qualify for tax purposes? And what that means for tax purposes, there's basically two tests: that you've spent more than 750 hours a year on your real estate activities, and that you've spent more time on your real estate activities than you have on any other job that you have. So what does that mean? If you work full-time job at 2,000 hours a year, and you are the one trying to qualify as a real estate professional, you would need to work at 2,001 hours to qualify as a real estate professional. Or if you worked 1,000 hours a year, a part-time job, you need to spend 1,001 hours on real estate. But again, if you happen to be married and have a spouse or partner, if one of you is working, the spouse or partner could be the one qualifying as a real estate professional. And if that's the case, they don't have that second test to meet where they have to spend more than 50% of their time on real estate. They just have to spend more than 750 hours a year. So we've seen it done both ways, but this can become very powerful, because if you are, like Amanda said, if you're generating enough depreciation expense through a cost segregation study, something like that, where you're creating a loss on paper for your rental properties, obviously you want to be able to use that loss and deduct it against your other sources of income. You'd want to do that now versus, spreading that benefit out over the years. And, qualifying as a real estate professional is one of the ways that you can definitely do that.
Yeah, and this is the one strategy I think that we often see in terms of our clients, shifting the needle from paying taxes at 30, 40, 50% down to, 15 or 12 or even no tax liability. So the more real estate that you invest in, theoretically, the easier it is to qualify as real estate professional, because you're spending more and more time in real estate. But I think kind of in today's market, with coronavirus and people being furloughed and laid off, we might have a unique opportunity this year that, if you're not spending as much time working, but spending more time in real estate, this could be a possible tax strategy for this year and hopefully future years and beyond as well. Okay. Retirement planning, I think we just want to touch on.
We lost
Hey,
audio.
Amanda, can you hear us? We have lost the audio. Hello. All right. Let's see if we can get them back. It looks like they're resharing their screen. Amanda, if you can hear us, and Matt, if you can hear us, type in the conversation window so that we know you're there. By the way, can people hear me?
Yeah.
Okay.
Yep.
Okay, good.
Yeah, we can hear you.
Yes, we can hear you.
It looks like,
It looks like they're not in the participant list anymore.
Ah, okay.
It was going pretty well too.
Good
Yeah,
stuff.
good presentation.
Can you
really
guys
good.
hear us?
We can, yes.
We can now.
Oh, okay. Sorry, it was so strange because we can hear you guys, but you stopped hearing us. All right. So I think we got cut off at the retirement planning, right?
Yep.
Okay. So
Make sure to reshare your screen. We're not seeing anything right now.
yes, I will.
Yep.
So, so there are ways you can use retirement money for real estate without taking distribution, paying taxes and penalties and things like that. The easiest way to do it is to move money into a self-directed account, whether through an in-service transfer with your current employer, if that's allowed, or with retirement money from previous employers. There are ways to do that tax-free, penalty-free. But we also want to talk about, because it's, recent tax changes of coronavirus, there are a couple of things that came out about that are allowing people to access retirement accounts earlier. And one is the coronavirus-related retirement account distributions. You want to talk about that?
Yeah, so if you need to take a distribution from your retirement account, now again, we're not necessarily suggesting this, but if you need the money to live off of, obviously, then this is an option for you. Now, before everything that just recently changed, if you take money out of your retirement account, generally speaking, before you're 59 and a half, you got to pay early distribution penalties in addition to probably income taxes, right? Well, now they're allowing people to take up to $100,000 of coronavirus-related distributions from their retirement account through the end of the year, and these can be free from the early distribution penalties. Now, This can happen from 401ks and IRAs. And the money is still, it's going to be free from early distribution penalties, but it's still going to be taxable. But if you repay the money back into the retirement account within 3 years, you can avoid having to pay the income taxes on it.
Yeah, so I guess, to give an example, let's say you have $300,000 in retirement. You decided, well, I want to take $100,000 of that and buy a piece of rental property. So what you can do, you can take this money out, use it for real estate, and then decide if you want to if you want to pay the taxes over a 3-year period, or if by the end of year 3 you decided, I've made enough money with real estate, I can now refinance and pay back my 401k or IRA. You can do that and avoid taxes as well as penalties.
Yeah, so it doesn't matter how you use the money once you receive the distribution, but in order to qualify for that category, it's got to be coronavirus related. So meaning you've been laid off or furloughed or reduced workload and because of the coronavirus, or you've been diagnosed with coronavirus, or someone you're taking care of has been diagnosed, things like that, where you can qualify under that rule.
Yeah. So here we have a slide that talks about it. Basically, diagnosed or financially negatively impacted, and this is a self-certification. So IRS has been very lenient on this. Your employer does not need to verify, or you don't need to really prove that you were negatively impacted. It's a self-certification process, and a lot of people are saying, well, yeah, everyone in California at least, or maybe across the nation, have been negatively impacted because of quarantine orders or the schools, kids' schools being closed. So the other one that was new is 401k loans. So in the past, you can take a 401k loan of up to $50,000, tax-free, penalty-free. Now for coronavirus-related 401k loans, it can be taken of up to $100,000. Okay, so you borrow money from your 401k and you can repay yourself back over a 5-year period, starting with next year. So similar to what we talked about earlier, the first one was distribution of 100. This one is a loan of 100. And one key thing, you can use both of these. Okay, so you don't have to choose one or the other. You can take out some distributions and borrow the rest. And whatever you don't get out, maybe you can do self-directed investing and put that into real estate anyways.
So a couple more things we want to mention are tips for real estate investors. One is opportunity zone investing. So this just came out at the end of 2017 with the Tax Cut and Jobs Act. And a way to think about this is that prior to that law change, for example, if you were selling stocks at a substantial capital gains and you wanted to diversify from stocks to real estate, you would have to sell the stocks, pay the tax, and then invest in real estate. And, that's fine. That's the typical way to do it. It's not the end of the world. But obviously, if you can not have to pay the tax and then reinvest the money, that's a better situation, right? So that's where the opportunity zone came out, is they're allowing people who generate capital gains from selling stocks, a rental property, selling your primary residence. Mostly, if you have capital gains, you can reinvest those capital gains into qualified opportunity zone investments. And if you do that, you get to defer the tax you would have paid on the capital gains all the way until the 2026 tax year. Now, that's one benefit. There's a couple other benefits. The big carrot they're dangling on the back end is if you can hold on to this opportunity zone investment, any appreciation you get in that opportunity zone investment, if you can hold on to it for 10 years, that appreciation can become totally tax-free. So that can make sense if you foresee yourself investing in one of these and holding on to it long term, or if you think the appreciation is going to be very substantial.
Yeah, and the one thing I just want to mention about opportunity zone is it doesn't necessarily mean the property has to be in war zones or the slums of Detroit. There are opportunity zone areas all around us. There's properties in Santa Barbara, all parts of California, Hawaii, New York. So that's something to definitely consider if you are looking to sell stocks and move that money to real estate, but you're facing a large amount of capital gains tax from the stock market. Okay. All right. So the last thing we wanted to talk about, this is the economic injury disaster loan. You might have heard about that, often referred to as the EIDL loan. So this came out as part of the CARES Act. I don't know if President Trump has already signed the second round, but I'm assuming he has already signed it or is signing it as we are on this call. So it is available for those with active real estate as well as for landlords. So who should apply for this kind of loan? Well, if you have rental properties and tenants are not paying and you need money to help sustain those properties, then this might be a potential relief to apply for. It's supposed to help with temporary loss of revenue. This is one that you apply directly on the SBA website. There's another loan that you probably have heard of called the PPP or Paycheck Protection Program loan. We didn't put any information on today's slide because I think it doesn't really apply to most landlords because you need to have employees that you are paying as W-2s for. I'm happy to take questions if any of you have those situations. But for the most part, for landlords, the EIDL loan is the one that's going to be more impactful. Okay. So what does this all mean? Tax reform, Tax and Jobs Act, CARES Act, both highly favor real estate investors of all types. But as you guys know, tax law can change anytime. And in fact, we're seeing it change on a daily basis right now during the quarantine period. So very important to make sure you talk with your tax advisors and take advantage of any current tax breaks while they are still available. And I think that's it for our presentation, Daniel. We are ready to take questions.
Hi, hi, Amanda. I know that you said earlier that, the HELOC loan is no longer tax deductible. What about the just like an equity loan?
So the HELOC is home equity line of credit. That's the same thing. If you take out a HELOC and you're just sitting on cash or you use it to go on vacation, that's no longer deductible. But if you took out a HELOC and you use that money for investment properties, then it is tax deductible.
Got it.
And I'm sorry, we can't see anyone's screen. And I guess I can't see anybody else. I only see my own PowerPoint.
Hey, Amanda, does the Opportunity Zone investment have to occur the same year as the same tax year as when the capital gains were earned?
So no, not necessarily. It just depends on the time of the year. So basically, from when you generate the capital gains, you have 180 days to reinvest the money into a qualified deal. So obviously, if that's in the same tax year it is, but if you sell your stock in I don't know December 1st, it would be the next tax year.
Okay, thank you.
We have another question here that says, is it specific to stock gains, or can capital gains, or can it be capital gains from an investment property that's sold?
Yeah, it's capital gains in general. So it can be capital gains from selling an investment property. It could be capital gains from selling a primary residence if you're above the $250,000 or $500,000 exclusion and still have some capital gains left. Or common one a lot with a lot of our technology clients is selling stocks at a capital gain.
Mm-hmm.
I have a question for the stock capital gain. So can we use the stock capital gain to buy a primary residence, and the capital gain from the stock can be tax free?
No. So the opportunity, historically speaking, when you sell stocks, you have to pay capital gains. This is the benefit of delaying the capital gain is only when you invest it in Opportunity Zone funds. And so generally that's the fund has to invest in investment property. It cannot be the use of a primary home.
What about the primary home also in Opportunity Zone and kind of like a house hacking kind of situation?
That's a good question. They haven't really come out with additional details about that. I like that term, house hacking. I don't know if the IRS is onto that terminology yet. The one thing I will add, so Opportunity Zone, generally, so you can certainly do these yourself, create your own fund, which is just an LLC owned by more than one person, and then, invest in a property that's in the zone. The other thing that must happen, though, is in order for it to be eligible for the benefit, you have to make significant improvements to the property. So what does that mean? If I buy a property for $100,000 and the building is worth $80,000, I need to spend another $80,000 improving the property because the government wants you to, create forced depreciation basically on that property. So in your scenario, if it's going to be partially primary home, yeah, maybe that qualifies, but you still would have to make sure that the rental portion that you are making significant improvements to it. So that's a gray area. I would personally stay away from that, because then you're starting to do a lot of carve outs. It's going to have to be a property that can be split in two, where one is going to be the home and then the other is going to be investment only.
Okay, we're starting to get a number of questions rolling in here. Francine is asking, do you recommend buying tax liens as investment properties? And I don't know whether you make recommendations like this or not, but I'll let you go ahead and answer it.
Yeah, I mean, so when somebody invests in a tax lien, the type of income they're generating is interest income. So you're not, you have a lien on the property, but you don't actually quote unquote own the property. So you're generating interest income. So that's going to be taxed as just like any other interest income. So in terms of whether that's a good investment or not, I mean, that's not something that we can answer because we're not financial advisors. But having said that, we did touch on doing self-directed retirement account investing. If you do want to diversify from your regular 401k or retirement account, doing stocks, bonds, mutual funds, and invest in some other things that are real estate related, and you open a self-directed retirement account, those are great accounts to use for generating or investing in tax liens, because that's the type of income that's taxed at the highest rate when you do it in your personal name. But if you do it inside your retirement account, it's just the taxes are going to be deferred all the way until retirement age. So that would be something to think about.
Yeah, and that's similar to notes. Note investing is kind of along the same line. But I guess ultimately, whether you're investing in tax liens or notes, if ultimately the goal is to foreclose and own the real estate, right, the underlying real estate, then you do get, once you foreclose and actually own the real estate, right, then you get all the benefits of a regular, landlord, which is depreciation and, rental income going forward.
All right, Ulysses is asking, if I am a passive investor in an apartment syndication and cost segregation bonus depreciation, do I need to qualify as a real estate investor to apply the paper loss against my W-2 income tax?
Great question. So the answer is yes. When you, regardless of how you invest, whether directly owned or through a syndication, whether the loss can offset your W-2 income is going to be dependent, well, first and foremost, on what is your total income. If your total income is under 150,000, then no, you don't need to qualify as real estate professional. You can use some of that loss to offset W-2 income. But if you're combined as a married couple, if your combined income is over 150, then you or your spouse needs to qualify as real estate professional in order to use that to offset the W-2. Now, on the flip side, if you qualify as a real estate professional, even though you're passive in someone else's syndication, you can use those losses to offset W-2 income, right? Even though by design you are a passive investor.
I want to jump down to the bottom comments really quickly. Alexandria says, I've read your books. I knew your names. Look familiar. I enjoyed them.
Oh, thank you.
Thank you.
And then jumping up, Gabe has a question. In general, do you know if COVID-19 supplies for the home will be tax deductible?
Oh, interesting. You mean, yeah, I guess the question is relating to whether it's like a qualified medical expense, maybe. I haven't seen anything about that specifically. I wouldn't be surprised if they address that later on this year, because clearly that's homes, businesses are all for the most part requiring those kinds of things. So I haven't seen anything specifically whether that's an eligible medical expense, but again, I wouldn't be surprised if they do add that in later on. IRS, there's so many things they're behind. Because there's just so much they have to give guidance on still. But yeah, we expect to see a lot of that for the rest of this year.
All right. Mohammed is asking, how do I know if the property that I want to buy is in an opportunity zone or not?
Good question. So all 50 states have qualified opportunity zone areas, and it was all, I think, if my memory serves me correctly, it was all kind of up to the local government's jurisdictions to decide which ones are opportunity zones. But there is a list on the IRS website. If there's I don't know the link off the top of my head, but if IRS.gov, if you go there and search opportunity zones, there should be a link that will pull up a map or an area, something like that will provide a list of all the information of where the qualified opportunity zones are. So you can, I think there's a way that you can search, by address and put it in or something like that. So that's what I would recommend.
Yeah, I think just to add for people, opportunity zone, like I said, it's not just buying a property in the zone, but you have to buy it inside of a multi-member LLC, and you have to make significant improvements to it. So practically speaking, for a lot of our clients who are not doing real estate full time, if you still have a job and you're doing real estate on the side, they don't really have enough time to do such a massive rehab project. And what ends up happening is they'll either invest in an opportunity zone that's through a syndication, right? So there's a syndicator and you're a passive investor, but the syndicator is doing all the work on rehabbing it, but you reap all the tax benefits. That's kind of the more common example of how we see it in practice. And then the other one is with new construction. So depending on the builder you're working with, sometimes you can structure it so that you buy a brand new construction property that qualifies as opportunity zone because it went from nothing to a piece of property at the time of acquisition. But there's a lot of intricacies to that, so definitely talk to your tax advisor before jumping into opportunity zone, because there's a lot of little details about that.
Okay, Yinning is asking, what about using HELOCs on syndications? Does a HELOC interest qualify for tax deduction?
Yeah, so if you borrow money on a HELOC and use it to invest in a syndication, you should be able to deduct the interest. There's a couple different ways to do it, and how you do it is too complicated to explain here. But at the end of the day, you should be able to take a tax deduction for it to some extent, depending on how you structure it. But yeah.
I think the key here is a term in the tax world we call interest tracing. So when you take a loan from primary HELOC or whatever, let's say you took out $50,000 or $100,000, make sure you have a clear way of showing how that money is used. So instead of just putting it into your personal bank account where you're using to pay for kids or vacations, put it in a separate bank account, and then from that bank account move it over to the syndication or to a rental property. So if you're ever audited, you have a clear way of showing, hey, this is how it went from the HELOC to my investment.
Mohammed is asking, which one is a good choice or the better choice, paying parents or kids through 1099 miscellaneous or through W-2?
That's a good question. It really depends. So I think, and the answer will be different for everyone, but just kind of some, general guidance. If your kids are younger, generally it's going to be a W-2. The reason for that is because for younger kids, you can potentially avoid payroll taxes, okay, if you're paying them through your sole proprietor. The other thing is when they're younger, it's harder to make the argument that they're a 1099 contractor, right? As a contractor, they're kind of their own consultant or business owner. So it's a little bit harder to make that claim that they're 1099. For parents, that's going to be dependent on the numbers. How much income are your parents making? Do they pay some kind of payroll or self-employment taxes already? But for the kids, it's more going to be W-2, especially if they're younger. The parents it's going to depend on the situation.
All right, and then Mohammed has a follow-up question saying, what's the minimum age that we should consider for paying kids for a business?
Hey, that's a good question. One we get a lot. So there's actually not a specific minimum age. And the reason I mention that is, think about diaper commercials, right? Babies are getting paid to work in a diaper commercial. So obviously an extreme example could be something like that. But it just has to be, the work they're doing has to be reasonable for their age and what a reasonable person would expect a 5-year-old to be able to do, or a 7-year-old, 10-year-old, whatever it is.
Yeah, there's also, employment law you need to be concerned with, right? So if it's a younger kid, if the state says, the kids can't work more than, 10 hours a month, you want to make sure you adhere to those rules. So that kind of leads back to the natural fact pattern of, there's no age requirement, but the older they are, the more valuable the planning, because the more income you can reasonably shift to them.
And the more money that you're spending on them as well.
All right, Abishai is asking, would someone who owns an owner would someone who is the owner of a real estate holding company be considered a qualified real estate professional even without meeting the hours spent criterion?
Good question. Good question. I haven't gotten that in a couple years, but so the answer is no. Real estate professional status is claimed by the taxpayer. That has to be a natural person. So you can't have an LLC and say my LLC does nothing but real estate because the LLC cannot be a real estate professional. That designation has to be claimed on an individual tax return. So what does it mean? It just means if you have an LLC, it doesn't really help you, but also doesn't hurt you. So if you naturally qualify, having properties in different LLCs does not disqualify you either.
And Mohammed has another follow-up question, and I'm going to generalize this a little bit here, but he says, can I pay my kids, say, $60K a year? What's the upper limit for you can pay your kids?
Well, I think it's the same answer. There's no upper limit. There's no lower limit. It's just reasonableness. So, the question is, how old is your kid? What can they do? And if you didn't hire your kid, but you didn't hire Daniel's kid or my kid to do the same thing, is $60,000 a reasonable market rate for what you're paying them? Right? I mean, on the tax side, how much is optimal to pay them, that's going to depend on what your income bracket is, right? So if you're at the highest bracket, if you have a teenager, or, we have people who are paying their kids when they're in their 20s. They finished college, they're not working, well, now they're living at home, so help mom and dad with rental investments. Maybe you can pay them a much higher dollar amount and take a deduction at your rate so that they could, they'll pay taxes at their rate, but it still makes sense overall as a family.
All right, and we've actually gone through all the questions that are in the queue. Oh, one question just came in. This is by Arun, and he says, if I'm renting part of my home and say that I bought some appliance like a refrigerator, can the price of the refrigerator be claimed as a tax deduction?
Oh, good question. Unfortunately, the answer, so the answer depends. If you buy a refrigerator for the kitchen that's used in the entire house, then no, that's not going to be eligible for bonus depreciation. But let's say you bought a mini fridge for that room itself, so your tenants can have a fridge, then that could be eligible for bonus depreciation.
All right, that's the end of our questions. I guess make sure to plug your CPA firm and how we can get a hold of you.
Yeah, we have two books that we wrote that was published by Bigger Pockets. The first was called Tax Strategies for the Savvy Real Estate Investor, and the second one is the book on advanced tax strategies. And so I do encourage you to check it out if you haven't read it before. It's also on, there's audio versions as well. You can get it on Bigger Pockets or Amazon. And the best place to check out new information from us is actually just via our website, which is www.keystonecpa.com. That's KEYSTONE CPA.com. And thank you so much for having us. That was a lot of fun.
Yeah, thank you, Daniel. Appreciate it.
Thank you very much for coming in. I'm going to throw out one last question that we got here really quickly. How should you hold real estate if it's in multiple states, LLC or series LLC?
That's a good question. Tough to answer that on a forum like this. What I will, because it's so unique to every person's situation, depending on your equity and risk and just kind of your entire net worth. But I will say this though, California residents, for anyone on the today on the webinar who's from California, we do have an $800 per entity per year fee. So when we talk about series LLCs, it can get very costly. So my best advice would be talk to an attorney about what they recommend for asset protection. But before you form any entities, talk to your CPA. Maybe do a joint conference call or a joint meeting so you're all on the same page. Because what you want to understand is, what is the liability, but what is the cost associated with entity formation, different tax returns, state filing fees, and then, determine kind of what is the optimal result in your situation for the benefit, but not as much cost.
All right, we have a series of people all thanking you very much for your time and saying it was wonderful. So thank you.
Thank you. All right.
Yeah, thank you. Appreciate it.
Thank you guys. Have a good weekend.
Have a great weekend.